Sanofi, a global and diversified healthcare leader, reports earnings for the first quarter of 2013. Jérôme Contamine, welcome.
Hello, Laura.
You're the CFO of Sanofi. What are your comments on the group's performance in the first quarter of 2013?
Actually, Q1 has been definitely a milestone quarter for the group. This is the last quarter where we've seen such a significant impact of the patent cliff. Both Plavix approval and eloxatin loss of exclusivity have impacted the sales and the profit of the quarter. At the same time, our growth platforms have continued to perform well. Diabetes, vaccines, and enzyme have posted double-digit growth. All in all, we have also controlled well our OPEX, but as a result of the impact of the patent expiry of Plavix impacting by 42 cents per euro our earnings per share, the earnings per share on Q1 has been 1.22 euro per share.
Do you reiterate your guidance for the full year, still assuming a strong rebound of growth in the second half to support reaching your full year targets?
So the performance of the first quarter is in line with the full year guidance that we gave on last February 7th. On one hand, the overall impact of Plavix expiry, which is a residual impact for the year, will be around 800 million euro, out of which 562 just for the first quarter. Taking this element into account, but taking also into account the continuous strong growth of our growth platforms, investments behind new growing areas, investments on expenses to support new launches, and rigorous control on cost on investments, I can reiterate our guidance for the full year, leading to a business EPS at a constant exchange rate being between flat or minus 5% versus last year, barring unforeseen event.
How confident are you regarding your growth outlook in emerging markets, given that you've been facing some challenges recently in OTC in China and generics in Latin America?
Emerging markets in general remain a core strength of Sanofi. We have generated more than 1/3 of our sales during the quarter in emerging markets, representing 2.7 billion euro and growing 6.5%. Both Asia, Africa and Middle East have been growing double-digit, and Latin America mid-single-digit. Eastern Europe has been suffering from the general economic downturn in overall the European Union, so that the overall growth for Eastern Europe, including Russia, has been basically flat, but declining in Eastern European countries as such. Going forward, we remain absolutely confident that we will be continuing to be well positioned to take advantage of the growth opportunity in these emerging markets.
Your diabetes franchise could stand to benefit from recent negative news flow from the competition. How confident are you in the outlook for your diabetes franchise?
So first of all, our diabetes division has posted another strong quarter of growth, reaching sales of 1.5 billion, a bit more than 1.5 billion euro of sales, growing by 19.6%. Clearly, sales growth has been driven by the Lantus performance, which has continued to confirm the status of gold standard with an overall growth of 21%, including 26% in the US. Now, Solostar sales in the US represent 57% of the overall sales of Lantus in this country. And also the result of the landmark origin trial have just been transmitted to the authorities both in the US and in Europe. The quarter has also seen a strong recovery of Apidra sales, which have been growing by 30% over the quarter. We've seen also significant improvement in the evolution of our diabetes R&D portfolio. First and foremost, in February, the European Commission has granted marketing authorization for Lixumia, our once-daily GLP-1 receptor agonist. We have started to market and launch and commercialize Lixumia first in Germany and the UK at the end of the quarter, and the rollout will continue over 2013. The EDITION trials, which are supposed to assess the new glargine formulation, is on its way. So the result of the EDITION 1 will be made available at the coming American Diabetes Association meeting in June. At the same time, the headlines of edition 2 should be made available. When it comes to device, due to the setback of one of our competitors, as you said, but also to the delay and the complexity of the development of the fixed flex ratio device, we have decided to focus on the fixed ratio device, and will give also the ADA more precise information on the timelines. So last, we have by now 2 biosimilar projects which have entered into phase 1 at the end of last year or beginning of this year, and which aim to enlarge the offer of diabetes treatment to diabetes patients. So as you can see, we have been very active in the diabetes area, and therefore we are quite confident that we can sustain in the long term the growth of this key activity for Sanofi.
Has the performance of Genzyme's rare diseases product portfolio met your expectations this quarter?
For sure, yes. I mean, Genzyme has posted another strong quarter of growth. The overall sales have reached 473 million just for the rare disease products, which is up 20% versus last year. Cerezyme have been growing close to 16%, and more importantly, Fabrazyme has more than double its sales over the quarter versus the first quarter last year. I remind you that at the first quarter last year, we were just at the verge of starting the production from the new Framingham facility. Since that time, the manufacturing situation has improved significantly. Now we have been able to build new inventory to recover market share and also to supply drug to new patients. So for all these reasons, we clearly are confident on the outlook of our rare disease franchise.
You've had encouraging results from the US launch of Aubagio this quarter. Can you comment broadly on your vision for Genzyme's multiple sclerosis franchise going forward?
So you're right that the second exciting thing in Genzyme is the rollout of a new multiple sclerosis franchise. So now Aubagio has been launched in the US since Q4 last year for patients suffering from multiple sclerosis. It's a once-a-day oral treatment. The sales have reached 20 million euro over the first quarter of 2013, and the prescriptions are broadly in line with the evolution of Gilenya over the same first quarter of launch. At the same time, the CHMP has given a positive opinion on Aubagio for the treatment of adult patients suffering from remitting relapsing multiple sclerosis. And Genzyme is also starting to prepare for the launch of Lemtrada. As you know, Lemtrada has been filed both in Europe and in the US. Our filing has been accepted by the FDA during the first quarter, and we expect the opinion from CHMP in Europe during the second quarter of the year.
Is there anything noteworthy to report at the first quarter landmark regarding your pipeline news flow? Are there any significant new phase 3 trial readouts or regulatory decisions for the remainder of 2013?
Well, it's important to realize that innovation for Sanofi as a pharma company is and remains at the core of its future, of its strategy. And we are pleased to see that progressively we see the emergence of a more robust pipeline. Just over the quarter, we got the positive CHMP opinion on Aubagio, which I mentioned before, and the European Commission gave its approval on Zilxumia, on Zaltrap, and also our 6-in-1, our hexavalent pediatric vaccine, Exion. Also, we are looking forward for a number of phase 3 data releases in the coming quarters, including our new glargine formulation, otamixaban, iniparib, and JAK2. So as you can see, all in all, our R&D division has been pretty active over the period. We have now 62 projects into the pipeline in clinical phases, including 16 which is either under submission for approval or in phase 3.
At the time you started paying down debt from the Genzyme acquisition, you stated that you were comfortable with a net debt position of around 10 billion euros. Today, you're already below this threshold. Therefore, what are the implications for your capital allocation policy? Should we expect more acquisitions, a stronger share buyback programme, or an increased dividend?
So you're right that we have slightly reduced our overall debt since the end of 2012 by around 300 million euro down to 7.4 billion euro. It's clear that the priority remains to continue to invest in the business. So we can just confirm that our first strategy is to go on with our strategy of bolt-on acquisitions. We have proved our ability to integrate and to handle well acquisitions. Just as of the quarter, we did 345 million euro investment into new acquisition, including the Genfar acquisition in Colombia. We are also increasing regularly our dividend. The dividend which is going to be paid in the coming days is 2.77 euro per share, an increase versus last year of 2.65, representing now a payout of 45%. And we are committed to bring this payout at 50% on the dividend paid in 2014 on the result 2013. We continue also to have a policy of opportunistic share buyback, firstly to cope with the dilution arising from the creation of new shares relating to the exercise of stock options. Just over the quarter, we bought back shares for a total amount of 400 million euro. So finally, I would say that we continue to have a strong balance sheet, which allows us to seize opportunities along with this strategy.
Jérôme Contamine, CFO of Sanofi, thanks very much.
Thank you for having me.